Hi, this is Mani from bsc2nsc.com. In this video, this is more like an update video for earlier video I used to do on, I made and uploaded on monthly income based on Nifty option selling. And here I'm going to be a more revised and an updated version with time, and I just wanted a few more things, refinements to be added here. So basically here what I do is I combine the buyer hedge as well as a seller hedge here. Okay, so there's an outer shell as well as an inner shell. The outer shell is the normal one wherein you sell multiple lots out of the money 600 points away from Nifty spot, and I also buy a cover 300 points away, or it can be 200 points away depending on your convenience. When you're doing 800 points away, a 300 point cover is fine because Nifty doesn't most likely cross the 800 point zone in a month. If it does, it's a very rare occasion, like 5% chance. So 300 points away, the purpose of the cover is to cut out the unlimited losses, and this is always an inconvenience. So a lot of people think about why should I do option selling when it carries unlimited risk. So you can always cut out the unlimited risk by buying cover farther away. So if it's 800 points away that you're selling, so 1100 points away out of the money, you will buy the cover. So the max loss per lot is restricted to today the lot size is 75. So 75 multiplied by 300 points loss, you will max book a loss of around 23k, 24k, 25,000 maximum. And out of a 60k capital that you require for selling an options contract, and this I'm assuming is with Zerodha. So if you're choosing a broker wherein the margins are relatively lower, then you may need to choose accordingly. So in this case, at least if it's 60k for the margin required, so per lot the maximum loss that you can make is around 25k, and this doesn't assume the profits made by the inner shell. So without assuming the inner shell, the max loss made here is 25k, and you would only allocate 50% of your capital on either side of the outer shell. One is the call option side and the other is the put option side. So considering both, the loss will get diluted to 12,500 per lot. So 12,500 on a 60k capital means that you lose around 20-25% of your entire capital, right? So this assuming that Nifty can go beyond this 800 point zone, and it can go 2000 points also. So we want to take care of a black swan event. For example, 1990 80, the Black Monday is a day when the US indices drop by 20%. So there's going to be some unplanned events wherein the index can even drop 20%. So there's no guarantee that it will not happen, and you will not be able to exactly predict when it will happen also. So in those cases, so when it moves 20%, and if you don't have this cover, then your entire capital gets blown, and you will lose your entire capital, and you will still run into losses which you will need to pay back. So that's a situation that you don't want to have. You want to sleep well when you're doing the strategy month on month basis. So you always want to go for the cover. Consider the cover as paying insurance for your car. So we most likely don't get into accidents, we don't make the claims, but we pay the insurance, we pay travel insurance. So consider it as insurance wherein you will keep paying this amount, and this will be mostly wasted every month. But then even though this gets wasted every month, the once in a 10-year, 20-year kind of a event which will wipe out your entire capital, on that day this will save that day, wherein your capital will get wiped out by only 20%, 25% at the max. So this cover is very important for that reason. So the outer shell, so this is a thing that I used to do separately earlier. I used to, there was a period of time when I used to be a buyer in options, hedging, buying both call option as well as put option at the money contract, waiting for Nifty to move 200, 300 points so that I can book profits in the inner shell. Doing this alone is a problem when you want to scale up your trading capital, because when you're increasing your trading capital, doing this and seeing the time decay and the options premium decay is very scary. So it's very difficult to do this alone. Similarly, doing the outer shell alone can also have certain months wherein Nifty, as soon as you enter the trade 800 points away, Nifty moves quickly like 500-600 points within the next 1 week, and the one side of the outer shell begins to bleed a lot. So in that cases, the inner shell will be in good amount of profits, and this will to a certain extent cover the losses on the outer shell, and so that will help. So, and if let's say the markets have gone up by 600 points over 1 week, so the inner shell will be in profits, and the put option shell, the outer shell, you can move it upwards to try and play defense. And so you have various options. So this is basically just the entry example. So later you will, based on the time left on expiry, you will need to realign and adjust a little bit, 2 to 3 times in a month, I would say, and you will get better at it as you practice this, and you do this for you can paper trade it, or you can try and trade in reality also. So it will take a year for you to understand when to realign. So what is a good safe distance? So normally 4 weeks, with 4 weeks to expiry, 800 points away is safe. 3 weeks to expiry, 600 points is safe, and 2 weeks away, 400 points is reasonably safe. Or no, I wouldn't say as safe as 800 points away in 4 weeks. So when you want to realign to 400 points away, you need to probably bring the cover much closer to 100 points away, so that the loss per lot gets restricted to 7,500 on one side, and considering both the sides, it will be restricted to just 3,500 rupees per lot. So which will be hardly just losing 6%, 7% of your entire capital, assuming Nifty crosses that point. So I hope I've driven the point here of how to play this strategy. And 8 lots you have to sell far away, and in this case, of course, you bought in the inner shell, you bought 1 lot. So when you're selling far away 8 lots, the cover can be only 7 lots, because there's 1 lot here covering the unlimited loss in the inner shell. So but just to avoid the confusion, I just made it easy to consider. So 8 lots you're selling far away, 300 points away, is buy 8 lots. So but if you understand this, and when you want to scale it up, you can make the inner shell 3 lots, outer shell 24 lots, and you can keep scaling this up in that ratio. And when you bring this with only 2 weeks to go, you want to come 500 points away, the outer shell, then like I said, you need to bring the cover closer, because the possibility of Nifty moving 400-500 points in a week is also there. For example, demonetization was announced during the expiry week, so there are cases where Nifty can easily move even 500 points within a week in the last week, let's say. So last week 200 points away when you're selling, so it may make sense for you to have a cover 50 points away, so that the maximum loss per lot is restricted to 3,000 rupees on one side, and considering both the sides will be less than 2,000 rupees overall. So so next is I'll try and give you an example of this just plainly states the number of lots, and for this you'll need a very high margin to play with, because selling 8 lots on one side and 8 lots on the other side, 16 lots put together, you'll need close to 10 lakhs or a little bit more than 10 lakhs to execute this. And if you have a lesser capital, so you can probably sell relatively closer. So if you have only 5 lots to sell, you can do this 500 points away even with 4 weeks to go. So ideally at the money contract will be normally around 120-150 rupees start of the month, and so both the sides you will be investing around 150, 300 rupees, and by selling 8 lots you will actually capture around 40% of the risk of the inner shell will get captured in the outer shell initially, and then later you can keep moving it closer to try and capture more. So if the inner shell is bleeding, the outer shell will make profits, and this will cover up for it. But eventually the idea is to make profits on both the inner shell as well as the outer shell. Inner shell you may not be able to hold till expiry, but you may have to exit on the second or third week or 1 week before expiry, and probably in the last week you will have only the outer shell. You will probably come out of the inner shell, book profits or loss before the loss widens in the inner shell. So ideally you want to book profits, and there'll be that rare month where you'll need to also book a loss on the inner shell. So but that'll most likely get compensated by the outer shell. So coming to the example here, so this is an example where Nifty spot is at around 10,400. I've assumed 10,400 as the Nifty spot, and preferably the inner shell you should try and enter at a point where you don't think Nifty will settle down. So the square values like 10,200, 10,400, 10,600, the midpoint 10,500, so 10,800, 11,000. So these are the spots where you want to ideally enter the inner shell. These are the points where Nifty ideally doesn't settle down. So you try and enter the inner shell at the money by around these levels, or important support or resistance levels where you don't think markets will settle down. The outer shell, of course, you can see since it is 10,400, 800 points away is 11,200 call. You sell 8 lots. Still further 300 points away, you buy the cover 8 lots to cut out the unlimited risk. Similarly, on the put side, 800 points away from 10,400 is 9,600 put. Sell 8 lots and buy cover at 9,300, 8 lots. So this will take care of the unlimited losses, the cover that you buy in the outer shell. And you normally tend to target 2% returns monthly, and if the inner shell makes really good profits, there'll be months when Nifty will move 500, 600 points. So on those months, the 200 or 250 invested in the inner shell will become, you'll be able to exit at 500, 600. So that will give you added returns overall. So you'll be able to book on the overall capital, you'll be able to book a decent return for that month. So to summarize the video, the purpose of the cover is protect your capital and cut out unlimited losses. Like I said, if you have to do this all your life and you want to generate monthly income for a real long period, so you're going to have to do this strategy over and over again. And you want to ensure that a black swan event, for example, P-note is in somewhere in 2008, 2009, if you remember, when finance minister said that we're going to introduce P-note, there was a 10% lower circuit in the index. So those will be days that will give you heart attacks, wherein the broker may auto square off your positions in losses. So even though on that day Nifty eventually recovered after the finance minister clarified, but while it happens, if there's an auto square off because your capital gets wiped out, your entire account goes into the negative. So you want to avoid all those cases. So that's why you need to have the cover in place. So big black swan events, you can read this book called Black Swan. So it's written by a foreign author, and he talks about traders who made money consistently for a period of 6-7 years, and they lose it all in one day because they haven't taken care of the unlimited losses. So whenever you realign, also you try and calculate what could be my unlimited loss here, what is the maximum percentage of capital that I may lose here in case Nifty crosses this point. So don't always be arrogant thinking that we've done our research, we have the software, we have the analysis in place, and Nifty is definitely not going to cross. So there'll be that very rare occurrences when which cannot be controlled by anybody, that can send panic to the markets and can crash or go up a lot also. So you need to always consider that the markets are going to defy you, markets are going to trip on you someday. So have this cover in place. It is very, very important if you're going to do this every month. And going on to the next point, the idea is to make profits in both the inner and outer shell, and we'll ideally not be able to hold the inner shell till expiry, because the inner shell is a buyer in option. So and although we are doing in less number of lots, you still want to book profits in both the inner shell as well as the outer shell. So the inner shell you may need to exit and even probably re-enter. For example, let's say you're entering when Nifty is at 10,400 and Nifty goes to 10,800. You can book profits on the 10,400 call and put and re-enter in 10,800 call and put. So that way you're booking profits and you're reinvesting a smaller amount in 10,800 call and put. And the third point is outer shell can be held till expiry and can be brought closer as well. So the key thing to note is that as you bring, as there is less time to expiry, you can bring the outer shell closer, like 400 points away, 500 points away with 2 weeks to go, even 200 points away with only 4 days to go. But when you come 200 points away, it makes sense to have the cover bought at 50 points away, so that the maximum loss is contained a lot, and you can scale this, you can scale up this strategy. You can allocate a higher capital as you get more and more comfortable with the strategy. But the key thing to note is that the cover is very important to cut out the unlimited loss and also to reduce the loss. So you can bring the cover closer when you are bringing the outer shell closer as you go towards expiry. And if you don't understand these aspects, don't follow this strategy, and paper trade it, and do it only if you get really comfortable in the markets, and you need to be minimum there in the markets for 3 to 5 years, so that you understand instinctively what is a safe distance in the market. And a lot of the terminologies that I use for option selling, for example, look at OA ratio analysis of the Nifty option chain and understand it. So you may understand that there's a bullish undertone or a bearish undertone for the current month, and this will help you realign probably only either the put option outer shell or the call option outer shell. And the OA ratio buildups at specific strikes in the out of the money can also help. So for example, sometimes there's a maximum OA buildup at 10,000 PE, so you know that you can push your outer shell on the put option to 10,000 PE. So these are things you can do, and like I said, as this requires a higher capital, do this only if you have a strong understanding of why you are using the cover, and do it only with the cover. And like I said, you should be in the markets for minimum 3 to 5 years before you can scale up the capital on these strategies for monthly income. And the next point is keep an eye on VIX and other factors to keep the outer shell at a safe distance. For example, like I said in this video, 800 points away most of the month, you're not going to have too much of premium. Actually, it's going to be like 6 rupees or 5 rupees. So if VIX is lesser, even with 4 weeks to go, you can sell 600 points away also. But you need to keep an eye on VIX and understand how the VIX changes. So the inner shell will also take care of VIX to a certain extent. For example, you're entering the trade when the VIX is at 14, and suddenly VIX starts jumping towards 18 and 20. The inner shell premium will also expand a lot, so it will start giving you some amount of profits while the outer shell bleeds a little. So normally the inner shell profits will take care of the outer shell losses, and the outer shell profits will take care of the inner shell losses. So this is a relatively fairly robust strategy to follow. And the last point here is that enter inner shell at the square levels in Nifty. To understand what are the square levels, check out my video on gun square levels, which is already there in the YouTube video. If you don't know where to find it, ask me and I'll share the link to you. That's it on this video, and you can drop me an email for feedback at rmoney84@gmail.com, or you can I prefer WhatsApp chats. So if you have any queries, and if you're in Chennai, you can come and meet me to talk about the strategy also, so I don't mind. This is my number, you can ping me on WhatsApp. That's it for now. Thank you. Bye bye.